Our critical audit matters analysis presentation is on Cisco, and Cisco is a global company that sells, markets, and distributes food to large companies. And over the past 5 years, we looked into it, and they had 10 acquisitions, which has a lot to do with goodwill, which is important because goodwill was their critical audit matter in their 10K, and it was the only one they had listed. So as of June 29th, 2024, Cisco's goodwill was valued at $5.2 billion. And goodwill is tested for impairment each year by the auditors, and it sometimes can be tested more often if there are signs of impairment, but the year-end 2024, it was only tested once in the fourth quarter. So why is this a critical audit matter? There are several reasons for that. And firstly, it is because testing for goodwill is very complex, and deciding what the impairment is also complex. It requires making several different estimates about the fair value of the assets of the company based on several different factors, which I will talk about later. And in this 10K, it talked about specifically 2 reporting units that were especially sensitive to different assumptions and their changes of the year. And goodwill is also listed in the critical accounting estimate section of the 10K, and that is because both critical audit matters and critical accounting estimates use significant judgment and high uncertainty. So how did the auditors go about addressing the goodwill? They did several things, which involved reviewing and testing the company's controls over the impairment process. And how they did that was by checking the methods that Cisco used, reviewing the company's key assumptions, and comparing past data to projected and industry data. Because goodwill is mostly estimated, you have to look at past data and projected data to get a fair valuation of it. And the auditors also brought in experts to help with the valuation methods and the cost of capital. The auditors also tested how the changes in the key assumptions would affect the company's estimated value of goodwill overall. So now we're going to talk about the potential inflation of earnings that could happen.
One of the things that the company could do is overvalue goodwill. The way they value goodwill is using the weighted average cost of capital method. This looks at the debt to value, equity value, tax rate, beta, risk-free rate that the company has to give it overall valuation. So what they would want to do is, for any one of these methods, is keeping WACC as low as possible. So that could be using optimistic assumptions. That would be ignoring current market conditions and using more of a historical outlook. This could make the present value of future cash flows higher, which therefore would make goodwill seem higher from different company acquisitions. They could adjust the debt to value ratio in the WACC formula. This would be in turn lowering the debt to value ratio. This would cause WACC also in the formula to become lower than it should be. Also lowering beta, so they could ignore some of the company specific risks that apply only to them. This would also, again, cause WACC to be lower. Another way they could overvalue goodwill is the delaying of impairment. This would be if the book value is larger than the fair value of the acquisition. So they could postpone the impairment test that Stella was talking about earlier. This could make it that if so, the fair value does become lower, that impairment could be weighted to be reported into another period. Another could be selective timing. This could be recognizing when impairment is recognized. So this would be a debit to impairment loss and a credit to goodwill. This could be they recognize it when there's more of a less of an impact of that impairment. So it could be when there's stronger financial impacts or anything other of that sort.
So now I'm going to briefly talk about the substantive work that the auditors did this quarter when looking at goodwill impairment. So starting at the very beginning, when Cisco acquires a business, they do the acquisition method, which means they acquire 100% of all of the assets and liabilities at fair value. If the purchase price is higher than the fair value of these acquired assets, the difference is the goodwill. And a lot of judgment is used when finding the goodwill, such as estimating future cash flows of the assets, deciding on the discount rate to apply, and determining the useful life of intangibles in the future. So once all of those judgments are done, then the goodwill is decided. And then what you do is you compare the fair value of the goodwill on the balance sheet to the book value. And if the fair value is less than the book value, then it is impaired. So this quarter, what the auditors did is they did qualitative as well as quantitative testing of the goodwill. So when looking at qualitative testing, it's mostly looking at economic conditions, market conditions, industry conditions to kind of decide whether or not you need to quantitatively test those assets. And this year there was a couple that only needed simpler qualitative testing for some of the reporting units, but for the other ones, especially those two sensitive topics I talked about in the beginning, they had to do quantitative testing. And the quantitative testing is, it uses two approaches, which is the income approach and the market approach. And the income approach looks at the company's future cash flows, and the market approach it compares the company to similar companies, which I talked about earlier. It's important to look at industry when deciding goodwill. And for 2024, it was determined by the auditors that the fair value of all the reporting units was higher than the book value, so there was no impairment necessary for the goodwill. And now we're going to finish up by talking about possible errors that could occur during all of this and reasonable assurance the auditors have about the value.
So some of the things that could potentially go wrong would be incorrect valuation of economic conditions. I mean, valuation is based off of nothing that's sure. So if you use a not wrong value, but something that isn't a correct value in the future, this could cause not an incorrect way, but just how it happens that an error to happen in the assumptions. You could also assume that this is going to happen in the market. Let's say the market's going to be good and then it could turn bad. This could become an error in the valuation of goodwill. The market volatility, the market's moving all the time. There's just not much someone can do when they actually value an asset. It just all depends on chance. Delays in impairment testing, this could be if the company and or the auditors are behind in their testing, whether they don't get to it or it's slower than it should be. The actual testing process itself, this could cause valuations, whether things are reported late and therefore the valuation is misrepresented to the time period. And subjectivity, like I mentioned before, valuations are not set in stone numbers. They're all up to interpretation, so therefore it's up to each person in themselves subjectively to decide what those valuation numbers should be. And to make sure those numbers are stated, auditors always should use professional skepticism. So we're assumed that that is just what we use, and not everything we see and test is going to be correct, just to make sure not to rely on everything. And just use the correct auditing testing procedures. Stella talked about before the different substantive, procedures and tested controls that auditors use to make sure that we keep these numbers in correct. In this case would be goodwill. Using those procedures in the right and correct way would be the best way to make sure our numbers are what they should be.